Hey guys, what's up? Alec back with another stock market and investing video. And today we have a great video. It's going to be a two-part video. And the first part is going to be Costco versus Walmart versus Target. Which stock, in my opinion, is the safest and which one's the best. And the second part is going to be Home Depot versus Lowe's. So make sure you stick around throughout the whole video so you can actually see the reasons why, and we'll go into some financials on each of them and see which one is actually performing the best currently. All right, so the first stock we have is Walmart, up about 2% today already, and it is Thursday today, by the way, when I'm filming this. It was even all the way down to 138 at one point. In the last 3 months, it's up 15%. And if you go to a 5-year graph, it's just up, like almost like a straight line. You can kind of see it has some hiccups here, but I would like to get in this stock right around like the 130 mark. I think is a fair price to be getting in at. But let's look at the financials. So if we look at the financials, you can kind of see that they have been consistently beating earnings here. And then if you scroll down and we look at their total revenue, they're not much of a revenue growth machine. So you probably won't see their price like skyrocketing up. It's just a steady trickle up. But then if you look at the balance sheet, which is kind of what we want to compare against these companies, you can see that in 2020, they have total assets of $236 billion, and their liabilities are only $154 billion. So let's see how that stacks up against this competition. All right, so we have Costco pulled up, ticker symbol COST, and the financials on the EPS, on the earnings, they're not beating it as dramatically as Walmart. So that's the first thing I noticed. And then we scroll down to total revenue. They are growing revenues more than Walmart. So you can see this one, the stock price growing a little bit more than Walmart's is because the revenue's growing consistently a little bit more. Now, if we go over to the balance sheet, Walmart has like 3 times as much assets, and the ratio on this one is about even, about 66%. So their balance sheets look very similar actually on the percent of liabilities to the assets. And then if you go to net income real quick too, it looks like that Costco has been growing their net income by double digits consistently every year, which is a really good thing when you actually want to look at growth of stock price also. So if we go back to Walmart, we have Walmart pulled up again. If you look at their net income, it looks like they actually were losing 2016, 2017, 2018, 2019, and then they grew in 2020 by 100%. And a large contributor to that was probably when the shutdown happened, everyone was panic buying. But same thing with Costco, but you don't really see that huge increase like they had in 2020. Costco is more of like a consistent grower. It's not just like one year they had like a home run and they hit a home run. They've been growing consistently net income for the last 4 years, double digits every single year, which is a good thing to look at. And they almost growing double digits in revenue every single year. And that explains why Costco is up 25% in the year. In my opinion, if you can buy like right around 330, I think that's pretty much a fair valuation for them. Anything under 300 is definitely going to want to buy. And I think it's possible to actually see the stock right around $330 again. So if you want to set a price alert from there, we have one more stock to compare against the two though, and that's Target. So let's pull it up now. So it looks like they have been beating earnings consistently as well. So if we pull up their revenue, it's almost the same thing as Walmart. They're not growing aggressively. Revenues only like 3% gains per year with the revenue. So I wouldn't say they're a huge growth beast like Costco is, for example. And their net income, they actually lost. It looks like they went down in 2017, 2018. They're still having $2 billion of net income, which is profit. And in 2019, they gained by 12%. In 2020, they gained by 12%. So that's a really good thing to look at, is they are gaining double digits on net income the last 2 years. Now, the balance sheet is what's important. And when comparing these companies against each other, these bigger companies, these bigger retail companies, and what you'll see is that their liabilities are way closer to their assets than Walmart or Costco is. So I would say that Target is a little bit more risky out of the three. And in my opinion, Costco is the clear-cut winner. You just have to make sure that you are going to be getting in at a good price point. So Target, like we said, about 3% gain today. And if you kind of go at their chart, getting in at this one under 150 should be the goal if you are set on Target. Other than that, I don't think it's really worth it in my opinion, and your money can be spent elsewhere. Honestly, I would probably only buy this one at 120 if it ever dipped under that. But in my opinion, the clear-cut winner is going to be Costco with that revenue growth, the net income growth, and they have the best balance sheet out of them. Like I said, I would want to be at around 330, but for me to actually go out of my way and spend money on this stock, I would probably be looking at about under 320 or even under 300 to get in at Costco. So the next part of this series is going to be Home Depot versus Lowe's. We'll look at them real quick and see which one, in my opinion, is going to be the better stock to buy. Right off the bat, I probably want to be buying this stock under 250. And for me to buy it personally, I'd probably be buying it like 220, just because I think I can put my money elsewhere and get a better return. And I'm a very patient investor, so I wait for opportunities to arise, set my price points, and once the price points go off, it's an easy buy. You know, if I set my price point at 220 and it goes off, I'm just going to buy Home Depot. Now, they've been meeting earnings. They haven't been necessarily beating or missing. It looks like they're on target to where they need to be. And their net income for Home Depot looks like it was negative in 2020, negative $200 million. And it looks like they only turned a profit the last few years of only a couple $1,000,000. You know, about $50 million was their biggest net income gainer. This is when it gets interesting, though. If you go to the total revenue, you can see that they consistently grow by double digits every single year. So Home Depot is a revenue beast. Anyone that's growing by 15% revenue consistently per year is a stock that actually catches my attention. But I like to scroll down and look at their balance sheet after that. Their balance sheet doesn't look too solid. You know, what you'll actually see is in 2019, they had about only $1 billion in liabilities, and they doubled their liabilities just in 1 year. From 2019 to 2020, they doubled their liabilities. Now, granted, they almost got $1 billion more in total assets, but their total assets are almost matching up with their liabilities, which isn't the most safe thing. But this is a bigger company, so I think they can consistently grow their stock price for the next 2 to 3 to 5 years, especially because their revenue, as you can see, is growing. Now, the takeaway on Home Depot is they're going to be more of a growth stock, so which means they're going to be a little bit more risky, and they're not as much of a value stock. When the value investing, you're looking for a safe, sound investment, and growth investing, you're looking for something that's just going to double your money or even triple your money in the next 3 to 5 years. So we have Lowe's pulled up next, and their earnings, their EPS, you can kind of see they've been consistently beating it, and it's been increasing too, which is a good thing to always look at. And the next thing is going to be their net income. So they're actually a positive company. So you'll see they're earning billions of dollars every single year and positive. Remember, Home Depot was losing money consistently, and they're actually negative this year. And then every other year, they only had like $50 million in net income. With that being said, though, their total revenue is not growing nearly as much as Home Depot is. So, and also their balance sheet is way worse than Home Depot. So honestly, in my opinion, I don't really like either of these companies. Their balance sheet is way too crazy. Lowe's, the thing about Lowe's is their revenue is not there. It's not growing double digits every single year, and their balance sheet's not there. So I wouldn't really consider this one a value company, and I wouldn't really consider this one a growth company either. At least Home Depot has the revenue growth. So I would say Home Depot is the clear-cut winner in this one, even though their balance sheet isn't where I would like it to be. Home Depot's revenue growth is what makes them the clear-cut winner. Now, like I said, personally for me, it's a little bit more risky, so I would wait till under about 230 for it to actually be a buy on Home Depot, which I think they can probably get back down to that price point because they're not as profitable as people want them to be. Lowe's, on the other hand, I'd probably honestly just stay away from them because they're really not growing revenues by anything special. They don't have a fantastic balance sheet, and they shot up crazy amounts. If you look in just the span of a couple months, they went up 161%, which is super risky to invest in a company with not a great balance sheet, not great revenue. Their net income's okay, but for them to shoot up 160%, they haven't been growing revenues by anything crazy. So if their revenue's not growing by anything crazy, but their stock price is, that's kind of a red flag in my opinion. And if you really want to get into this stock, I would say about under 120, anywhere from $100 to 120 is when I would probably personally buy. Other than that, I probably wouldn't touch it. I would just stay away for a little bit. You can actually see right now it's on the way down. So I can easily see this one going back to at least 130 if you do wait a little bit. Now the PE ratio on Lowe's is going to be 22, which is actually pretty good. The market cap is 112 billion, and they actually have a payout of about 1.4 dividend yield. Home Depot is pretty similar. Their PE ratio is 23, which is right where we want it to be. Dividend yield is 2%, which is always nice. And then the market cap is almost 300 billion. So they're basically twice the price. Also, Walmart PE ratio is 21, so it's even better. Dividend yield is about 1.5%. And look at that market cap. They're almost a half a trillion dollar company. And if you guys do need help getting your profile a little bit closer to where mine is, about 7% in the week, 22% in the month, I have a few more spots left for the coaching. So reach out to me on Instagram. I'll be more than happy to help you out. And honestly, in my opinion, if you got this far in the video, I'll let you know, I'm not going to go out of my way and buy any of these stocks. They're really not that attractive to me. Costco and Walmart, I might be looking into those a little bit if they hit like a 50% decrease or 30% fall in the market, in the share price, then they might catch my attention a little bit. In my opinion right now, there's just other places in the market where you can put your money and get a better return over the next 6 months to a year. And these stocks were actually requested by viewers on the channel. So go ahead and comment below on what stocks you want me to compare against each other next. Or if there's any stocks that you want me to do a deep dive into some financials, go a little bit deeper. Price points, I think they're fair for them. And some financials on the company too. And until next time, guys, remember, don't time the market, buy the market. Peace.